So today we learn how to build wealth at NSE using our app and also online trading platform. Specifically today we are going through the order entry screen so that we understand various settings. Last week we went through the whole process of onboarding, funding, trading, and how you make money at NSE. So today I've narrowed down to order entry screen. We go into details and also market depth. Then we'll also go through indexes and also ETFs. If there is any at NSE, you'll be able to see. So let's proceed. So we'll start with market depth. And market depth, as you are aware, it has two columns. One is bid and the other one is ask. So bid is demand, that is buy side. Ask is supply side. So let's go straight to the portal. Today I'll demonstrate with the portal. Let me log in on the portal. I'm logging in on my real account. We are connecting to NSE straight. Let me just log in. So now when you log in on the portal, the first pop-up you get is refer and none. As I said last time, maybe Axys have provided a way for you to make additional money by referring a friend. They open an account using your unique referral code. And all the trades they do, there is that commission we charge. We are sharing with you 50% for 1 year. It is posted in your account, which you can withdraw. The easiest way of sharing this code, don't share the code as it is. Click copy link, then you can share with your friend. When they open, I hope you can see the next screen. My code is already defaulted. So nobody can change these. So you are assured that client will be tagged to you. So let's close that. You want to click on buy screen, then I explain the order entry screen. Next week, I will also be going through the portal, but today I want to go through the order entry screen. So we have two types of orders. We have normal and ODD, both on app and on portal. Normal means you buy in multiples of 100. So lot size here is 100. Let me select share so that we can see that. Let me pick up, sir. So at the normal, you can see the lot sizes in multiples of 100. So you buy 100, 200, 1 million, 100,000. So that is in multiples of 100. You buy it at the normal. ODD, however, is where you can buy one share to 99. So anything that doesn't make up over multiples of 100. So 1, 2, 3, 50, 99 shares you can buy from ODD. Why is this case? You may put some money in your account and you buy in normal lot in multiples of 100, but you don't fulfill the whole amount you have deposited. There is that small amount that is left in your account. Don't leave it. As I have said before, it doesn't earn you interest. Always utilize full amount in your account. So here, if let's say you are buying 1,000 shares and you have put 10,000, you have utilized up to around 950,000. So you are left with around 9,500. So you are left with around 500 amount in your account. Don't leave that amount. It can be used to buy one share, two shares. So you only need to divide the amount that is left in your account with the share that you want, the price. You see the number of shares you can buy. If it is 55, you can come and put here 55 at the ODD. So at the ODD, you buy. At the ODD, you buy in less than 100. That is 55. You can buy 69 shares. Why is this case? This amount, if you are buying a stock that is giving dividend, that is dividend stocks, you'll be entitled to get your dividend. If you are looking for growth stocks, these are the stocks that don't issue dividend, but they have a chance of rising in price. So you buy low, you sell high. So you make money through capital gains. And you don't need to sell immediately. You can hold them for as long as NSE and CDSC are in operation, because they're the ones who provide the shares and the trading platform. So any share you buy at NSE, always make sure either it gives you a dividend or it is a growth stock. All those recommendations, they're always given by our research team. Any stock you see they are telling you there is a dividend coming, that is a dividend stock. If they tell you a counter, yes, it doesn't issue dividend, but there is future growth in price, then that means it is a growth stock. And not just that, there are counters that offer splits, bonuses, and also dividend in form of additional shares, that is bonus. Those mostly are growth stocks. You can always buy them. So ODD is where you buy in less than 100. Now, let's say you want to buy 100 shares and 150 shares. That order you split into two. 100 shares will go to normal. So you complete and submit. Then you put another order, second order for ODD for the balance, that is 50. So that's how you play around with the screen. Normal, you said in multiples of 100. Any balance you leave in your account, do mathematics with the balance divided by the price. You see tentatively the number of shares you can buy. Selling is the same. If let's say you have 259 shares and you want to sell, you sell 200 at a normal. Then the balance you sell at the ODD. So that's how the market works. And the details that you can see here at our watch list and also on the app are for the normal route, normal board. So the prices that you can see here in demand and supply. For ODD, we are working with NSE to provide that. Hopefully they can provide in good time so that you're able to see both markets. Then you have security. Security is the share you want to buy. Then quantity is the number of shares you want to buy. Then there is a price at the bottom. This is the price that you want to buy at. The price is determined by two things. Your urgency, that is when you need those shares, and where the market is moving. If you need shares immediately, then you don't need to put any price. You can put here as a market. And market order means, let me put this screen aside. There is this other screen that has two color codes with a bid and offer. I'll come to that when I'm explaining market depth. If you're buying and you put 1.8, the price that is quoted here, it is the current price for the buyers, the people who are buying. That order will execute immediately because there is supply based on the number of shares you put here. However, when you're buying, you can put any other price if you know the counter price is coming down. And that is informed by something we see at the head called stock index. It's very important. You have seen it on NSE price list and also our research team sharing commentary on stock index. It's very important. It tells you where the market is going and whether that counter is moving up or down. We'll come to that in details. Then validity is number of days you want to put your order. Day is a day order. That is, it will expire at the end of the day if it is not executed. GTD is good till date. So you are putting your order, then you give it some number of days, up to 7 days. So the order will keep on being refreshed every day if your price is not the current trading price. Let's say you had put at 18.5 and current price is 18.8. You see now your order won't execute at that point. But if you had done your research and you know the counter is coming down in price, you can put 1850. Then you give it 1 week. Maybe within that 1 week, the price will have come down. If it doesn't execute, it will cancel immediately. Then there is a IOC, immediate or cancel. It means immediately you send your order. If it doesn't execute immediately, cancel my order. So that's what it means. Immediate or cancel. Execute my order immediately or cancel it. Why is that case? Let's say I wanted to buy 1 million shares. Let's use the example that is there. Let's say I want to buy 2,000 shares. The current supply at 1880 is 1,200. So I have a short of 800. The orders which are coming in, as you can see, there is only one order for 1,200. Maybe somebody else will put as I put my order here. So immediate or cancel, that is IOC, it says go to the market, get me the 2,000. If you're not able to fill, cancel my order. So it will check, is there orders, is the quantity enough to buy 2,000? If it is, it will execute immediately. If it doesn't, it cancels. So it won't execute the 1,200 if it is immediate or cancelled, because it has to check even the quantity. These orders are usually used by traders when they want to do something called cross trade, where they want to trade with somebody else. So I'll put my 2,000, the price, then IOC. My counterparty will put the same 2,000, 1880 IOC. Immediately we submit, it won't execute with the queue that is there, because there are conditions we have met, both of us. Any other validity here is subject to market availability of shares, and this is not market manipulation for immediate or cancel. Remember, I may have my account at AIB Axys, and maybe I have another account with Axys Group as a stockbroker in Kenya. I want to use those examples so that I don't market for the other stockbrokers. So there is AIB Axys, and there is Axys Group as a broker in Kenya. I want to transfer my shares from AIB to Axys. I either fill the form, which will take some days at CDSA, or I can come and sell from Axys Group, put the same conditions, IOC. Then at AIB, there is another trader who is putting my order again as IOC for the same quantity. It will execute immediately. The reason why I've given that example, you are not, when you're trading here, you're not trading within the same brokerage. You are trading in the market, NSE, with other traders and clients. Like all these orders, they are coming from all over the market. So that is the IOC. The other one is FOK, fill or kill. This means when I submit this order, the market should fill my order completely, 2,000, or it should cancel my order. Kill means you cancel. So fill or kill. Immediately buy the 2,000 without waiting at that price, or cancel my order. That can apply. Let's say here I want to buy 1,000. As you can see, there is an execution that has gone in and reduced the quantity to 1,100. If I'm submitting, remember the other people who are submitting buy orders. So to make sure I get the exact 1,000, when I submit, it will go and check at 1880. There is already 1,100 shares. So it will execute 1,000. But if there is another order that came in before me, earlier than me, let's say 500, so the balance will be 600, my order won't fill, so it will be cancelled. So in this case, you find a trader is looking at getting the those shares at that exact price, 1,000 shares at 1880, without having to come and refresh the order again. So that is fill or kill. Then we have order type, we have limit. Limit is where you put a price. Then you have market. Market is where you don't put the price, but you're telling the system, go in the market, get me the available shares. What does that mean? This order for 1,000 will come in and check what is the current supply and the price. If it is able to fill my order, it will execute immediately. However, let's say I put a 2,000 here as the quantity, order still market, it will be submitted as a buy. It will first clear the 18.8 because there is 1,100 shares. The balance of 900 will now execute at the next price of 18.9. That is the risky nature of market orders. However, if I put like 200,000, as you can see, there is enough shares in the market. It will come first, clear the first one, clear the second one, clear the third one. Then the balance will clear at 19. However, let's assume I had put 2 million shares and I have funds in my account. It will clear everything. Then the balance, it won't be converted back. It will be cancelled. So for market order, it clears. If it's not able to fill your order, the balance is cancelled. Then there is market to limit. This is where the difference comes in. You are saying go to the market, get for me the shares that are there. If you're not able to fill my order, remember for market, it cancels the balance. If you're not able to get me all the shares, convert my order to limit in the current price. So the last order that executed, that's the price that will be given to your order. So the reason why a client would want to go for limit order is when you're cautious about the price and you want to give it some days. Let's say I want to put at 1850. I don't want to buy at 1880. So I already know the market is coming down, so I can put limit. Market is where you want to buy or sell the shares immediately. So you don't care about the price. You want just to execute. Maybe you have made enough money. Then market to limit is where still you want to execute everything, but there is not enough supply or demand to fill your order. So you are saying just execute everything, then convert my order into a limit so that when another order comes in at that price, now I can execute. Then we have trading mode, we have delivery and intraday. Delivery, as you are aware, NSE from the previous training, we said delivery is tied to T+3. You buy today, AIB Axys will give you a portfolio in your account, but that portfolio you can't sell the same day. You have to wait for settlement, and this is by regulations, CMA regulations, T+3. So trade date plus 3 working days. On the 3rd working day at 5 p.m., that's when your shares become balance free. So you can only sell on the following day, on the 4th day. That is at the delivery. So between the trade date and the settlement day, your shares are not balance free. They only become balance free. That is, you don't owe anybody. You have already paid for your shares. They are released by CDSE for you to trade. On the sell side, however, when you sell today, you can use that money to buy shares immediately. That's the beauty of AIB Axys. You sell and buy immediately. So selling doesn't have any issue, because as we know, CDSE will pay us on 4th day. So you can still buy your shares today because it will settle again. So there will be the net effect will be 0. Let's say you sell and buy shares back. You're utilizing the money would have been paid, and that money you are buying back shares. Then we pay CDSE. So the net effect is 0. So CDSE, on the CDSE side, remember the sell side settles first. So CDSE won't set those funds because they're expecting to receive the same funds. Maybe you bought a different share. So that is on delivery. However, payment for sales at the delivery are tied to T+3. So you will receive your money at 5 p.m. from the bank. That is CDSE. That's when they credit us. Then we pay on the 4th day. However, the AIB Axys again have come up with an innovation unique in the market where you can withdraw your money the same day you sold. It's called early payment. There is a small charge of 5%. Because us, we have gone ahead and taken an overdraft with our bank. That's our loan, which you pay for those 3 days. So we are paying interest. So it's always good now we share that interest with you because we are providing a credit facility for you to get money early. So AIB will seed part of the interest, then you help us pay part of that interest, the 5%. So you are paying 5%, AIB pays the 95%. So that's how it works. So don't ask where we are getting this money from. So we are charging a small fee to facilitate that early payment. And that fee, the reason is there is interest we are paying for paying you early. And you can request anytime within the day. So let me check whether there is any question. A minute. Question, put on the chat. If you have any question, put on the chat. Let's continue. Then we have intraday. So delivery, I hope you have understood. Buy side is tied to T+3. That's the one I want you to understand. Buy side T+3. Now we come to intraday. Intraday, as it says, it's trading within the same day. So you can buy ABSA if you have cash in your account and sell ABSA same day. Remember, under delivery, you can only buy and sell on the 4th day. So intraday, you can buy and sell, buy, sell, buy, sell. And for your trade to qualify as intraday, it must have a counter transaction. If you bought, you must sell. If you started with a sell, you must buy back. Why? At the end of the day, we take the total charges. That is a commission we have charged you on both sides, the buy side and sell side, the total commission. The side that have higher commission, it's called first leg. The side that have a lower commission is called the second leg. So AIB is not charging you on the second leg, the lower commission. Also NSE, they are not charging you NSE levy on the lower side. However, settlement remains. Shares will be balance free on T plus D. So the market, when the market closes today, the shares that you have in your account, if you bought, that is the net position is buy, that portion of buy will settle on T plus 3. If you sold, the amount that you sold will be debited on T plus 3. So your portfolio will balance the following day, on the 4th day. That's when now you see the actual shares that are remaining in your account. Why? In CDSE, I said transactions settle individually because you are selling to somebody else and you're buying from a different person. On the sell side, it is still the same as delivery. If your net position is sell, the balance is put in your account and you can withdraw either on normal settlement, that is you'll be paid on 4th day, or through a repayment. So however, I've explained the order entry screen. If it is not clear, let me know on the chat. We'll repeat the same thing on Wednesday. So that's on order entry. Let me stop sharing this. So we have gone through order entry screen. And I've explained market depth. So let's go to the next. We have order confirmation. So when you're submitting, you get a confirmation. That's where the charges are posted. Then you submit to the market. Your order goes straight to NSE. If you're trading between 9 and 3 p.m., you're connecting to NSE. When market is open, if it is closed, on top it shows closed. It means it's from 3 p.m. to the following working day, 9 a.m. So that time your order will be submitted on the back office. Then when market opens, it will just be pumped in. Then you have a small duration between 9 and 9:30. That time, that's when you can put limit orders, orders with prices. Market orders, they are not allowed in that period. Then exactly 9:30, that's when the first executions happen. And after that, between 9:30 and 3, it's free trading. All orders are accepted. Order status, we have different order status. We have pending order. Pending order means it is in the market. Remember what I said in the queuing. If you're not able to match the current price for sellers as a buyer, your order will be queued on the price that you have put in. That order is pending, waiting for prices to come down and execute. Then you have off-market order. It's orders that you put when market is closed. Then fully traded, that is straightforward. Your order have fully executed. Partially traded, it means part of your order have executed, balance is pending. Then cancelled, that is straight. Then expired order, that is the duration that you have put your order have lapsed, or it is a market order and it wasn't able to fill full quantity. So I wanted to clarify on that so that for those who want to trade, they can proceed to trade today. Once we are done with the presentation, or even from tomorrow. So let me pick a few questions as we continue. East Africa cable situation. This one, I think, let me comment at the end. With the delivery, if you wait T plus 4, I assume 5% interest will not apply. Yeah, when you are requesting, you have two options. You have normal, that is on settlement day. That one doesn't have charge. However, if you are withdrawing earlier, it has a charge. And that screen for withdrawal will actually give you, there is a split in the screen. One side for normal settlement without charge, and one screen with a charge. And you can see the amount that will be charged. And it is you now to make the decision. Do you want to be charged that amount? If no, then you request on normal day. And you don't need to come back to the system to check whether you'll be paid or not, or whether your payment have been released. On the fourth day, our finance team will just release your cash. Are there cases where limit prices might change to market price? No. By regulations, we are not allowed to change any of your prices. What you put there, the prices that you put, is what you'll execute. If you said market, it will execute with market prices. If it is limit and you have put an exact price, it can't change back to market unless you come and change. Remember, you can amend order. You can change from limit to market. Maybe you put a price and you realize the market is going up and you did those shares, or you want to sell, you can change it to market. But there are no instances where system can change that from limit to market. It's only market to limit, and it is you who will have put it when you're submitting the order. So let's continue. I hope that is clear. So today I want us now to go a bit deeper at NSE, and we handle stock market index. They are very important. I know you have seen these on NSE price list and also our research reports. And these play part in your investment, whether you make money or you be stuck with the shares. Stuck means you'll be left with shares that you are not able to sell at a loss. So today we'll understand NSE 10, 25. There is also NSE 20 and NASI indexes. So what is a stock market index? Stock index tracks performance of a selected group of companies. Let's say Safaricom, Equity. For argument's sake, we'll come to that breakdown. You want to know where the market is moving. It's only through stock index you can be able to tell directly where the market moves. It's not just the prices. If you have to do prices, it means you have to go to individual stocks and check where the movement is. But with just a stock index, which is usually given by NSE on the price list and also by our team, you can always tell whether market is going down or not. So stock index will show whether market is going up or down. Why is this the case? When you're buying shares, you want to buy low, sell high. If you want to sell your shares, then it means you need to know where the market is moving and whether prices are either going down or up, so that you know whether you're making money or not. So I would compare this to a scoreboard for overall market. If you're a fan of Premier League, there's that table you usually see with team performance. Treat stock index as that. It's a scoreboard for shares at NSE. It will tell you whether market is going up or down. The same thing. If you look at that Premier League table, you can tell which team is going up or down. And you can compare a team against others. Like you can say, for argument's sake, Man U, whether they are doing well compared to the other team. You don't have to go and check the other teams individually what they are doing. With an index that reflects how other teams have performed, you can tell between the index for Man U and other teams whether Man U is doing well in the league or not. It's the same thing here. If you have an index for Safaricom shares over a period of time, and you're comparing that with other stocks in the market, you can tell whether Safaricom is performing well or the prices are going down. So you have 3 key indexes. There is one which is missing here. There is NSE 10. It has top most liquid stocks by market activity, that is by volume. Then you have NSE 20, that is top 20. Then you have NSE 25, that is top 25 counters. Then we have NAS, which is NSE All Share Index. It represents all listed companies. So for NAS, it shows an overall market performance. The others is now the individual stocks, the 10, 25, or 20, top 20. Yeah? So let's go to NSE 10. This focuses on liquidity and volume because the top 10 shares, they have high liquidity and also they trade in high volumes. These are heavily traded counters like Safaricom, Equity, EABR, and KCB, and others. There are 10 of them. I'll be sharing that in our WhatsApp channel and Telegram channel so that you can know the top 10, the NSE 10 shares. Once we complete with this, you see the reason why you need to focus on some of these. They're ideal for short-term trading strategies. That is for a speculator. You're buying today, sell tomorrow. So you need to focus on shares that are moving in volume, in price, and also they have high liquidity. You remember, you are buying to sell. If there is no liquidity, it means you buy shares, then you have to look for a seller. But if there is already sellers who are available, it means there is high liquidity. So NSE 10 focuses on the heavily traded shares. Then you have NSE 20, that is it covers top 20 companies. Then you have NSE 25. This is by capitation, and by investors for stable long-term growth tracking. If you want to invest in long-term, because some of those stocks are not that liquid and they don't have high volumes. Then you have NAS, NSE All Share Index. It includes all listed companies, including ETF, because NSE there is one ETF. We'll come to that. And it reflects broad market performance. So it will tell you whether NSE is performing well or not. In the news, when you hear news anchors say NSE market performed well today, they are referring to NASI index. It means NSE All Share Index moved up. We'll come to that. It's best for understanding general investment sentiment and also long-term economic trades, because it covers all shares that are listed. Then why do you need to know these indexes? One, it shows market direction, whether market is moving up or down. So if any of the index is moving down, it means the stocks that are within that index, their prices are going down. If it is moving up, it means some of the stocks within that index have performed well. And there are reasons why a stock could perform well. We'll come and see that. Also, it shows investor confidence, because if then the index is going down, it means there is panic selling. There are more sales. There are surprises driving the prices down. There is panic on the sales side. If it is moving up, there are more buys than the sales. It means there is a panic on the side of buyers that the price might shoot up, so they want to buy quickly. And remember, the sellers on the other hand, they might withhold the shares, so you'll be forced to buy at higher price, forcing the prices to go up. It also helps you to compare individual stock performance. Like you can compare Safaricom performance against the other 25 listed stocks at the NSE 25 index. Also, the indexes are the ones that are used to build ETFs, exchange traded funds. We'll come to that and explain what they are, and also mutual funds. So how does it work? As I said, think this is a Premier League table, where instead of having now those football teams, you have top 20 stocks, top 10, top 25, or all stocks. Instead of having those goals listed there, you have share prices and performance. So if goals increase, remember the teams are moved up. The same thing. Price moves up, share moves up in the index. So if a majority of, let's say in the NSE 25, you have 25 companies doing well, then the index is rising. If most of them then drop in performance or price, the index falls. That's why I said in the previous screen, it helps you know the market direction and also know when to buy and when to sell. If prices are going up, then you only need to wait for a few days. Then when price is in your favor, sell. If prices are going and you have money, that's the right time to get in. Then when the prices start to rise, that is the index starts to rise, then you can sell. Why should it matter to you? If a stock performs better than the index, it means it is doing better than most top companies. What did I say here? It helps compare individual stock performance. Then here we are saying if a stock performs better than the index, that is the stock index is better than the whole let's say NSE 25, NSE 10, NSE 20 or NASI indexes. It means that stock is doing better than those stocks, and it offers better returns. Remember, you are in the market to get returns, either in form of dividend or growth or capital gains through growth stocks. However, if your stock is lagging behind, that is, it's not performing well, that is when you compare that stock against the index, you realize the index now is performing better than the stock itself. It means you need to reevaluate your investment. That is, you either offload that stock and switch to another one, or you diversify. That is, if you have more money, don't invest on that stock, but buy another stock for growth. So let's use an example here. We are comparing Safaricom, for argument's sake, against the NSE 25. So what you need for you to compare, you need some data. You need Safaricom price over some time and NSE 25 share index values for the same period. This you can get from, for Safaricom prices, you can get from AIB DigiTrader and also NSE website or NSE price list. NSE 25 index values, you can get them from price list that is shared by our research team on our website and the price list section. So that's where you get these values. So you need share prices, let's say in January, and current price for Safaricom. Then NSE 25 index value in January and current value. You compare the two and see the growth. So let's take an example. Let's say you are comparing January to date. In January, the price was 18 and current value of Safaricom is 22. We are just taking example here. So the growth here is 22 minus 18, which is 4 shillings. Then you divide that by 18, then you get a percentage, which could be 22.2%. So that's how I've come up with the percentage. So the current price minus start price, where even if the price is down, let's say it is 10 current, that's what you use, because now the growth will be negative. So you use the current price minus where you want to track that day the price, then you get the percentage growth. It could be a positive, this one is a positive or a negative. Then you take NSE 25 index value at still same January, let's say 1st January, 1800 points. Then current value, let's say it is 1890. So the difference is around 5%. So if you look at this, it means Safaricom is doing well than the stocks that are within NSE 25, the top 25 shares within that index. So in conclusion, what does this mean? Safaricom have grown faster than the market. So it has outperformed the other stocks. And that signals something that Safaricom maybe could offer a dividend, or the price can continue moving up if it is a growth stock. I'll show you where the indexes are in the price list. Let's first complete on the index part. So index movement in action. So if NSE 25 goes up, then it means the majority of the shares within that index are gaining. And I use the word majority because it's not all of them. It doesn't mean all of them they are gaining. If it goes up, it means majority, because they are the ones who are contributing. There are the others which could be going down. So if Safaricom rises more than 25, we have seen under this example, Safaricom growth 22.2% against 5% for NSE 25. So in this case, it is outperforming the index. And this helps you to make buy, sell, hold decisions. So when you see our team giving you stock recommendation, they are telling you this is a buy recommendation, sell recommendation, hold recommendation. They have used the index that counter is in and compared against the other shares before they tell you it's a buy, a sell, or a hold. So you then how do you use indexes for smart investing? First of all, benchmarking. So you are tracking how your portfolio compares to the market. So you can even create your own index. That is by tracking your portfolio performance. If let's say you have shares for Mumias, Safaricom. Okay, let's remove Mumias because it's not trading. Let's use Safaricom equity and let's say BAT and ABL. You can create your own index and compare each stock against the rest to know whether your portfolio is performing well. You can also use now your portfolio, you just do an average performance. You compare against, let's say, NSE 25, NSE 10, NSE 20, NAS, depending on the stocks that you have. That's why I said I will share the list of stocks and where they belong to. Because you have a stock in NSE 10, it will also be in NSE 20, 25 NAS. NSE 20 have the 20. It will also be in 25 and NAS. So I will share so that you know where your portfolio lies, so that you know what you are benchmarking against. So if your stocks are beating the index, then you are doing well. So that's why you need to know index and how it works. So just take your portfolio, the prices you bought at and current prices, get the difference, get the percentage, the percentage performance or growth. Once you have that, compare with, let's say, NSE 25 or NAS. If your stock is performing, if your stocks are performing well than that index, then you are doing well. You don't need to off-road. It means part of your buying individual stocks, they are packaged into one ETF and you buy it as a one unit. So you are buying part of equity, part of EABR, part of another share that is included there at a lower price or at a higher price. Because let's assume you have EABR and a share like KPLC in the same ETF. You are buying KPLC when the price is average, you might find you are buying KPLC at a higher price, but your EABR you have bought at a lower price. Remember, it is at a fixed price. Here you are not buying individual stock. You are buying like an entire package. Let me give you a good example. You want to buy mangoes, oranges, and bananas. When you go to market, you have an option of buying individually. Remember that cost is high. However, there could be a seller who have packaged oranges, mango, and your banana as one, but selling at a certain price, where maybe that banana you'd have bought it at 20, but you're buying it at 10. So ETFs, you're buying an entire package of stocks as a one unit. We'll come to Absa Gold, because ETFs also mean something else. Like Absa New Gold is the one that is available and at NSE. I don't think we have any other ETF at NSE. But in the international stocks market, we have that. And also within our funds through Axys Group, you can get some of these. Indexes also help you in diversification. You reduce risks by using index trades to spread investment. Then also market timing. You are checking whether index is rising or falling. Then it signals you to adjust your strategy, whether you want to buy or sell. So let's go to NSE price list. We see where those figures are. Let me open NSE price list. Let me first share so that you see where to get these. So you go to our website, aibaccessafrica.com. You go to research, then price list. So I've gone to research, price list. Under research, you have other reports. Then we'll use equities price list because that's the one we are tracking. So if you scroll down, ignore the prices. You don't need to do any calculations here. NSE have done it for you. It is here. This is a small table you can see here. It has the performance. I think it's not clear. It's because of zooming. I had to zoom, but you can download these and check. So you have NAS is the first one. Then you have NSE 20, you have NSE 25, and you have NSE 10 shares. And also from our research reports, you don't need to go to NSE website. Everything is on our website. Follow index-linked ETFs announcements. And also consider using index trades to rebalance portfolio periodically. Then consider dividend-paying stocks within the index component. While we are coming to corporate actions next, once we are done with ETFs. We have had ETFs, but what is it in simplified term? ETF is exchange traded fund. It's like a basket of shares bundled into a single tradable unit. They trade just like normal shares. As I said, in NSE we already have Absa Gold. If you go to international markets, you have others like S&P 500 and others. They trade just like other stocks. You buy the same way. You see that order entry screen, that's where you put in. When we bring stock, international stocks into DigiTrader, you'll be able to buy them directly. Even now, when you submit orders to us, you'll be able to buy ETFs. Remember, we are already live trading through our trading desk as we work on DigiTrader. Once it is complete, you should be able to buy them directly from the app. And that's why you need to know what these are. It lets you own many companies in a simple single investment. So you're buying equity, Absa, Safaricom. Within that execution you have done, but you on your side, you don't know the units of individual companies you have bought, because that is tracked by ETF. You don't even need to think about what is inside. You only need to know this ETF represents this and this is its performance, and which sectors does it cover, so that you know whether it can be affected by any change in the sector. Think of this as a supermarket bundle of items. Instead of buying individual items separately, like you're buying unga, sugar, salt separately, they are bundled together into a package, then they have a price. So you're buying that one unit, but inside it, there are other items. So that's what ETFs is. How do they work? In simple terms, you buy one ETF unit, then you own small parts of all companies inside that ETF. It is traded in real time, just like normal shares. You are just placing orders normally. You can see prices, you can see executions, everything. They're usually managed by professionals on the back end to match the index it tracks. So that you don't need to worry about. Benefits of ETF, you have easy diversification. You own multiple companies at once, low risk than buying one stock. So let's say you're buying Safaricom equity and Absa as a ETF. If ABSA is affected but the Safaricom price have gone up, it means your risks have been reduced for ABSA. What if you bought individually? It means you'll be hit. Yes, you gain on Safaricom, which would be a small gain, but you'll be hit directly by ABSA. It also offers an affordable entry. You can start small. Like I said, you have a counter that is trading, let's say, for a single unit, it's trading at 200. It's packaged within an ETF with other counters. Remember, its price will go down. So ETF is allowing you to buy that expensive stock at an affordable rate, but you don't know that that stock is within that ETF unless you do now your research to understand what stocks are within that ETF. They're also liquid, buy and sell anytime during market hours, and you don't have to look for a seller or a buyer. They are listed within the same market that we saw for ABSA. So you have the ETF listed there. When you click, you see demand and supply. It's also transparent. Holdings are public. Whatever is contained in that ETF, if you were to go into details, you will know what it contains. So let's compare between ETF and individual stocks. So ownership, ETF, you own many companies as a single unit. Here for shares, you're owning one company at a time. Risks, for ETF, they are spread out. Individual shares, they are higher if company falls because you are affected directly. Cost, for ETF, it is shared. Remember I said it is averaged depending on how that ETF was created. Then for shares, it's forecast. You are paying for that stock exactly what you're supposed to pay. We have an example at NSE. For ETF, we have ABSA New Growth ETF. For shares, we have Akina Safaricom, Equity, and the rest. So let's take an example of ETF at NSE, ABSA Gold. This is used to track price of gold. So one ETF is like you're owning a fraction of that physical gold it is tracking. So when you buy one unit, one share of ABSA Gold, it's like you're buying a fractional ownership of the physical gold that is being tracked by this ETF. These ABSA Gold is already listed at NSE, and you can see it on DigiTrader in our portal. ETFs, they also invest in global assets. They help you invest in global assets like gold directly from Kenya. Now, in international market, it's the same thing. And also the funds that we have with our Axys group. That is the parent company that owns AIB Axys. Then how do you buy ETFs at NSE? You just open the normal CDS account. On DigiTrader, on the portal, that account you open there is the one you are using. Fund your trading account using M-Pesa, using bank. Then you go to your watch list, you search for either New Gold or GLD. The code for it is GLD. Then you just monitor demand and supply, decide on the price or order type. Then you just place the order regularly, just like you are buying shares. Then it goes to your portfolio valuation and you start tracking its performance. And you can track that ETF against other NSE indexes to see if it is performing better than physical stocks. So you can tell whether when you bought ETF, you made the right decision. If its index is higher, when you're comparing now with all shares, NAS, we have said about NASI index, and you find ETF is performing better, then you made the right decision to buy ETFs instead of stocks. It's the same thing with international stocks. When you're buying, compare the ETF performance against the physical stocks. If ETF is performing better, just go for it. If it's individual stocks, however, they are performing better, go for them. So why ETFs are smart? One trade, you have many top stocks within it. Safer entry into stock market. Remember, it's diversified. There's spread and works well for long term, also for dividends, because the stocks that are within that ETF, if they declare dividend, you still get it. So if within ETF you have stocks that are declaring dividend and others are not declaring, it means you are still getting a dividend, a portion of the dividend. What if you bought stocks, individual stocks that are not giving dividend? It means you never get dividend. But within ETF, then you qualify for that dividend. And it's also good for passive investors. So now we come to corporate actions. I want to go through them, then we come to Q&A. What are corporate actions? We have seen them, the price list. We'll come to price list. I show you now with an example. These are company decisions, listed company decisions that directly impact a shareholder. Anything that is announced, it is approved by the regulator and made that announcement through NSE, it will impact you directly. Anything you see at the corporate actions, if you own that stock, it will impact you directly. Why? There are various types. One of them is bonus issues. We'll come to that. We have rights issues. We have dividends. We have stock splits and reverse splits. Then you have mergers and takeover, and we'll come to each. So analogy, it's like changes in a game. There are new rewards if you own stocks. That is dividend, bonus, extra rise, like when a game goes to an extra time. So you have extra stocks coming in through rights issue or bonus issue, or upgrades that affect players. Those are like mergers and takeovers. Remember, when a merger comes in and stock is delisted, then you need to be paid. Remember, when you buy, you become a shareholder. When you sell, you cease from becoming a shareholder in any company. It's the same thing. Mergers, if they say they are delisting, it means the existing shareholders will be moved out. If merger or takeover doesn't delist that company, you still continue now as a shareholder. That is, if it continues trading at NSE. So the impact of corporate actions on you: bonus shares, mostly is on dilution of share price, but you hold more. So you get more shares, but the price goes down. So if they say we are giving a bonus of 1 share, 1 share for every 10, then the price will go down with the same ratio in some cases. So you find the price of shares have gone down, but you hold more. So if that counter moves up, as we said last time, you gain through capital gains. Remember, you have additional shares you got for free. Rights, you buy raw, then gain later. Again, the rights come in at a lower price than buying actual stock in the market. So when you buy rights, they are listed, they'll come now start trading as that stock. Let's say it is KCB rights. You buy KCB rights if they are trading in the market, or if you have shares, you're entitled to those rights. When you pay at a lower price, when they list in the market, they convert to actual shares. So you'll be trading them now as KCB shares. So when the price keeps on increasing for KCB, capital gains. If they issue a dividend, you get it. Then there are dividends. It is income you get, and you can reinvest. We will come to dividend investment. Then mergers, your shares may be converted or get bought out. Converted means if that company changes their name, then your shares will be convert maybe from one company to another. We have seen that with the NCBA. The others which have been bought out, where investors are bought out, then you are paid. And all these CMA will have communicated in advance. AIB through our digital platforms, that is our social media, we'll always let you know everything. That's why you need to invest with AIB Axys. We have bonus shares. Let me explain what it is. These are free shares given to existing shareholders. So a company announces profit, but they don't want to give cash to their investors as a share. They do it as additional shares, then reinvest these gains. So these are no cash dividends. You don't receive cash, but your shareholding increases. A good example, get 1 free share for every 10. So you get more shares, and if that counter will declare dividend next year, you get more dividend, maybe in form of cash that time, or even as a bonus. Then you have dividends. These are cash. Most of them, they are cash, but there are those companies that decide to give bonus, as I've said above. So cash dividend, money directly to your M-Pesa or bank, paid by registrar. It doesn't come through the broker. Or you get bonus, which are also called script dividends, extra shares instead of getting cash. That company, instead of giving you that profit, they give you more shares, then they reinvest that cash for expansion. So you have different types. We have final, that is the final dividend before they close their books and now distribute. Then there is interim and there is special. Interim is in between. Most cases you find it's mid-year, that is half year. Special is when a company have extraordinary profit and they want to share with you. Like Safaricom, they usually do that. To get this, always check NSE price list. I will come to that because I need to explain a few terminologies there quickly. Then you have rights to issue. Company offers current shareholders to the right to buy more shares at a discount. And if you are not a shareholder, the current shareholder who are entitled can denounce their right in the market. That is, they sell those rights to you, then you can pay for it. Remember, when they are listing back, they are converted to shares. The purpose of this is raising additional capital for expansion. But remember, this company is already listed. They can't list again. Remember, companies mostly list through IPO, so they can't do another IPO. The best thing they can do is to issue rights to get more capital. So you can buy more, that is, you take rights. Decline, that is, but your ownership, remember, you reduce because you're not taking the additional shares, or you can sell them in the market if they are tradable. You think of rights like a royalty deal, buy more, pay less. It's you to decide, do you want to go into that deal? Do you want to decline it? Or do you want to give it to somebody else? That's what that means. So before we come to dividend reinvestment, let me show you where these corporate actions are. They're in NSE price list. Let me share that. Then I quickly go through the terminologies. Then we go to the last part of the presentation before we come to Q&A. So in the price list, just below share index, there is corporate actions. Again, let me zoom in. I know it might not be visible well on your side. Like you have a Safaricom share, Safaricom, which announced a final dividend of 0.6 Kenya shillings. The announcement was done on 9th May. So you'll get the announcement date. Then book closure. This is the day they close their books and close something called register. So anyone who have shares and book closure is on 31st July. So if you have Safaricom shares on 31st July, the total you have at 5 p.m. is what qualifies for dividend. So you'll be in that register. If you sell before the 31st, up to and including 31st, remember at 5 p.m., those shares will not be there. So you will not be in the register. That's why I said at 5 p.m. when market have closed, the total you have is what qualifies. If you sell on 1st of August, remember books closed on 31st July, you still qualify. It's called ex-dividend date. Ex-dividend date is 1 day after book closure. So you find this term in international markets, ex-dividend dates, that you qualify for dividend in international markets 1 day before ex-dividend date. It's the same thing here. That 1 day before is book closure, even in international markets. It's only that they don't use that term. But in NSE, you find book closure. Is the date you need to have those shares. Now, 1st August is usually ex-dividend date. So you find Safaricom when it's trading, it has a EX notation in the price list. It means it's ex-dividend, 1 day after dividend. Then payment day is the day you receive your payment. Even for other corporate actions, book closure is the date you need to have shares. for you to qualify for that corporate action. So that's what I wanted to clarify. And there are many stocks that have declared dividends, and we'll come now to dividend reinvestment. Let me stop sharing. I hope that is clear. Let's go back to the presentation. We got to the last part of presentation, then I come to Q&A. So dividend reinvestment, what does it mean? You are using dividend to buy more shares. So when you receive your dividend, don't use that dividend for other purposes. Buy dividend stocks. It's called compounding. You are earning on your earnings. So you are using your earnings, the dividend that you have been paid, to earn more dividend or capital gains. It helps you build long-term wealth. So you return that dividend in, buy another counter that is offering dividend, and you keep on cycling. It works well with all stocks that pay dividend. There are many stocks that offer dividend. You can always get that list on our stock recommendations. Then there's something called dividend recycling. This is where you are using dividend to buy another dividend stock. You get paid by that stock dividend. You use that dividend to buy another stock that will pay you dividend. We'll come to that. So let's say Safaricom pays a dividend on 15th July. You receive your money, let's say 3,000 at some date. You use that dividend to buy now that company, let's say X, that is about to close books now after you have received your dividend. Let's say Safaricom will pay their dividend on July 15th. So on July 15th, you receive your dividend. Then within corporate actions, there is another company that they announced they are giving dividend, and book closure, let's say it's on 1st August. So you buy that counter using that dividend. Don't sell until 1st August. You qualify now for that. You have used your dividend to buy another counter that will give you dividend within the same year. Let's say now that counter dividend will come around, for argument's sake, September. There is another counter that have announced book closure maybe in October. You use that now dividend you have received to buy that counter. So you are investing in dividend stocks and recycling. That means you have created a cycle of revenue. Meaning, when the first counter declares dividend, you get this counter you bought with that dividend after their book closure. It will be, let's say, a few months ahead. So that month again, you receive another dividend next year. So you keep on getting dividends continually. It's like you are getting passive income monthly. It's like a salary you are getting monthly from dividend. So you repeat that and grow your portfolio passively without you going back to your pocket. You're using that dividend. Before we come to portfolio balancing, I think that is the last part. Let's go back to price list. Now we see whether that is possible in NSE. Dividend recycling. Let me share. Let me see if there is one book payment date 1st of August, 31st, 30th July. Like if you had Jubilee Holdings, their payment day is on 25th July. So that was it's today. So you will receive that dividend either today or within this week. But within the same corporate actions, there is another company that have not closed books. Let's see which one. Safaricom, their final dividend, which book closure is on 31st July. So you can use Jubilee Holdings dividend and also BKG if you have it to buy Safaricom shares before book closure. So you put, when money comes in, put that money before 31st July, buy Safaricom shares. There is also another company, I think Equity, will be paying on 30th June. Diamond Trust Bank, again BAT. All these have their payments are before 31st July. So you put those dividends into Safaricom. Then on August 31st, Safaricom will pay you another dividend. Remember, you used this dividend you have received to buy Safaricom to pay you a dividend on 31st. If there is another corporate action, let's say another company says, we have announced another dividend, book closure is on 5th September. So you will use now Safaricom's dividend to buy that counter. If their payment day is in October, once you receive that dividend, check within corporate actions whether there is a company doing book closure after your payment day. Buy that counter. So you are using dividend, you are recycling a dividend within stocks that are giving you dividend. Then you can use your other cash, no, not dividend cash, to buy growth stocks that are not issuing dividend. So you keep on cycling. Within a span of 10 years, you have created a portfolio that is paying you dividend regularly, maybe even quarterly. First quarter, you have enough money to take you for the next quarter. The next quarter, there is another company paying you. Third quarter, the same. Fourth quarter, the same thing. So that's how you build a portfolio using dividends. Let's go to portfolio balancing, then I come to Q&A. So what is portfolio balancing? It's a process of spreading your investment across different assets to manage risk and increase long-term returns. So you don't just invest on one stock. You invest in various stocks, like the way I've given an example of dividend stocks, where you're using one company to buy another. You are diversifying and buying different assets, stocks at NSE. You also invest in bonds, that is fixed income. You also invest in funds. We have them with our Axys group. You also invest in international markets. So you have diversified your risk, and also you're increasing long-term returns. Remember, when stocks are affected at NSE, international market is still trading. Your funds are still growing with Axys group. Board's interest might go high. So you still have other investments that are giving. When interest rates drop, you find NSE now it has picked up. Again, you have not sold anything. So think this as not putting all your eggs in one basket. Remember, if you put them on one basket and it falls, you lose. That's what it means. But if you diversify, you put one egg in this basket, then the other one in another basket. Even if one basket falls, the other one doesn't fall. Maybe it is in a safe hands. So why then do you need to do portfolio balancing? Reduce risks for major losses. Then smooth out ups and downs in the market, so that you're not affected by price fluctuations on one asset. Asset here, I mean different items that you're buying in the stock market. It could be shares, which are stocks, bonds, funds that you're investing in funds, or investing in international markets. It also prepares for different market conditions. One time when NSE is down, interest rates are high. It means your bond is giving, or interest rates for funds are high, or international markets have moved up. Like now there is war in Iran. We would expect it to affect international markets, same as NSE. But you find within that there are assets which have not been affected, or even stocks that have not been affected. Then you build a portfolio that aligns with your goal. That it could be you are looking for growth, or that is growth is in terms of long term. So you are growing your wealth, so that when you retire, you have something to take care of you, or even pass it to beneficiaries. All these are assets you can pass to your beneficiaries. And remember, when you're opening account, always appoint your beneficiaries and let them know where you're investing, so that in case anything happens, they don't need to start hustling where checking with the records where you invested in. Then there is income. Remember, dividend is something you are receiving. Even in your old age, you still be receiving that dividend, and also for safety. Key diversification options is you can decide to invest in sector-wise or geography. That is, you use NSE for local and global US, EU markets and other emerging markets. There is funds with Axys Group. Like we have a very good fund, Africa Axiom Fund. You can always get in touch with our team. They will explain everything to you, including what you start to gain. Then assets. As I said, assets here, you could have shares, bonds, ETFs, REITs, cash, or even funds. Cash here means you have deposited your money in, let's say, a core account or a savings account, or insurance savings plans. Risk profile, it's a mix of high risk, that is growth stocks. They are considered as high risk because of price volatility, and dividend stocks, they are low risk because your price fluctuation is compensated by dividend. Then there is fixed income where you are always receiving that interest coupon. Coupon is also interest. So let's see a difference between a poorly balanced and a balanced investor. So you have an investor who have invested in 100% in tech stocks, like Safaricom. You have put 100%. All your money is in Safaricom. If that sector crashes, you lose. You'll be stuck with that counter forever. Look at what happens with mere shares. Everyday stocks. Let's say you invested in everyday stocks. You'll be stuck forever until that stock moves up. But again, it doesn't mean these are poorly balanced. Look at what happened with KPLC. It stagnated at 1 shilling, below 2 bob. But what is current price? It has picked up. It's all about government policies and company, whether it is innovating. So if they innovate, expect price can come up. Let's say for argument's sake, let's say everyday they decide, instead of us offering the normal batteries that they sell, why don't we make batteries for electric vehicles? We are moving to that. Kenya is moving to that, where now everybody will be owning an electric vehicle. Do you need to import that battery? They can start manufacturing them here. It means they have diversified their investment. And again, as a growth stock, price will move up. So it doesn't mean even if you invest 100% in one stock, it's a poorly balanced. It's only the risks that are very high. That's why poorly balanced here means you are taking higher risk by investing in one stock. However, you could have high gains, but again, high losses depending on the price movement. Now, for a balanced portfolio, you could say 40% of my investment, let's go to banking, the other one to tech stocks, the other one to bonds, the other one to ETFs or funds or international market. You are spreading this across sectors and assets. It's still in long-term growth. So we come at an example at NSE. You can decide I'll take a few shares. Maybe I take banking sector, equity, KCB Bank. Then telecoms, I take Safaricom. Insurance, I take Jubilee. Energy, Kengen, Toto or KPLC. Manufacturing, I take BAT and EABR. So you invest in at least 3 or 4 different sectors. And if possible, if your money allows you, invest in all sectors. But always check, as we said, index performance and also research recommendations. What other people are, the professionals who analyze stocks, what they are saying. You can also go for a local and international mix. You say, let me take NSE shares, which you are familiar with, and they are local. We take ETFs and global stocks, that is international exposure. Bonds and treasury bills, still income and safety. Remember, you are assured of your interest unless there is a default by government, which rarely happens. I've never heard of it. You can also go to Forex and CFD. And remember, in the introduction, when we did introduction, we said these are very risky. Just check any poster or any website by Forex brokers. They always tell you it's a risky product you're getting in. It's for speculative purposes, but it's highly liquid and you can gain or lose. There is also funds which you can get now, as I said, with our parent company, that is Axys Group. Adjusting your portfolio over time, you need to keep on balancing your portfolio periodically. We will just buy and leave the shares there. Always check performance of your stocks against index. We have seen stock indexes that are there in NSE, even in international markets. Always check, then you rebalance. You can offload what you have made profit, or where you see you make high losses, you can exit early before you are hit, then buy something else. You sell overperforming or overweight stocks. If you gain, there is no need of holding on that stock unless you want to have it there forever. You can sell it, buy another stock, or sell and wait for the price to come down, buy it again. Then you can use now the gains you have made by selling to buy undervalued stocks, underweight stocks. But remember again, check stock recommendations, what they say about that stock. So for young investors, we take more risks. Remember, you're investing early, your money will be there in market volatility. But again, as time moves on, the price will go up. For old investors, we look for more safety and income. Remember, you're looking at your retirement, something that will be giving you dividend, or something you can withdraw and use it in your retirement. When you're getting your pension on retirement, you have stocks that are beefing that up so that you have you safeguard your retirement period. Real-time rebalancing, you invest your portfolio, let's say 100,000, 30% Safaricom, KCB, BAT, Absa Gold, Treasury Boards. Here, you are looking at a regular income. Safaricom is giving you dividend, KCB is also giving dividend, BAT is also giving dividend. Then there is capital growth. These are counters that move in price. These are just examples I'm using. Doesn't mean these are the only things you can buy. Then sector and asset diversity. You have bought different asset sectors and different assets. Remember, you have ETF, you have shares, and you have treasury boards. Then you are protected from inflation by gold and also bonds. Bonds that give you interest. Then tools that helps you balance your portfolio. You have NSE and also EIB website. NSE website, you get sector information. You also have our trading apps and portal to track performance through portfolio valuation. Then you have research reports. Mostly you can get that from us. Then you have ETF and index charts to understand your exposure. This you can always get on online sites. If you do want our research team to also give these, because now we have gone to international markets, we are offering ETFs. You need this. ETFs or index charts for NSE, I don't think, unless you want to see performance of any index over time, then you can always ask our team for advisory. And with that, let me go to Q&A. This is the time now we go through questions. Are there plans by any broker or fund manager to provide index funds for NSE 25 and NAS? This I'm not quite sure, but I know NSE could be working on something. NSE could be working on something alongside it. So for index funds, I think NSE, they have so many innovations they are doing. This could be in their pipeline. If it's not in their pipeline, I think as at AIB, as I said, I'm in product development and innovations. I'm the head. I'll talk to my team. We see if we can propose these so that AIB Axys can become the first broker at NSE to offer this, because it's just packaging. You're just picking the NSE 25, then they are offered as one unit, but there are technicalities behind it. I think that's why NSE have not offered these, but hopefully in near future it will be provided, but in international market it's there. What effects will be on share price when government sells some of its shares? Mostly, I don't think there is that effect, because Safaricom, they're just selling they're offloading part of their shareholding, the public, for you to continue trading. Unless the other factors that may affect company, I don't see government moving out of our stock and the price is affected significantly. There could be some effects, because remember, when government moves out of our stock, it means you have lost a major shareholder who can provide liquidity easily. But I have never seen a stock which is affected that significant into those significant levels. But never be worried. CMA will always, if there is any cautionary information out, CMA will circulate it and they halt the market. Remember, we said NSE, they have that switch to stop the market, to stop that counter from trading, to protect you as an investor from possible losses until they know measures that have been put in place to either compensate you or make sure the price doesn't go way below. And remember, in the market, unless it is open day means that 10% rule doesn't apply. You're always protected by 10% rule. Your prices can't go outside that bracket. Is it possible to earn dividends when investing in ETF? If stocks within that ETF, remember we said ETF is a makeup of many shares. If let's say we have an ETF in NSE, Safaricom, KPLC, and other stocks, and Safaricom declares dividend and it is within that ETF, then that ETF is mandated to pay dividend because Safaricom is within it and it has paid that dividend. You still get that dividend. But remember that ETF, the people who are managing it now need to factor the dividend they pay you. Because remember, you're not buying an individual share here. You're buying many shares package as one. You only have a part of Safaricom. Would you kindly share these notes on email? I'll share that. I'll also post it on, there's a blog that I'm posting this information, because a blog is permanent. It's not like a website where if we change our domain, it will change. That blog is permanent. That's why I've used that domain, so that even if we change our domain from AIB Axys, you can still find that blog. I will also share these notes and previous notes and also videos. I have seen there are people who have said they want the recording. I'll be sharing that. For the last Wednesday, I'm about to finish editing because it had my personal details. For this one and the Friday one, I just need to brush through to make sure it's clear. Then I upload it. How can ETFs be ordered in NSE via AIB Axys platform? At NSE, Christian, we only have one ETF, Absa Gold. If you go to, let me just share that screen. Let me just share in your interest so that, because NSE, we only have one ETF currently. We don't have any other. Hopefully more can be listed. This one here, GRD. But there are no supply and demand. That's the downside of ETFs at NSE, because it's not many people who have invested in these, and it's because information have never been given out. Not many people know what is ETF. But now that you know, you can always buy and sell. Maybe there are orders today, they executed, today none. I don't think there is any other. So GRD is gold, new gold. It's the one for Absa Gold. So that's the only ETF at NSE. I don't think there is any other. When doing dividend recycling, does it mean once you get dividend from the next counter you sell everything? No, you don't sell anything. You're not selling anything. You have received your money as dividend. Remember, your shares have not been sold. They're still at CDSE. It is the registrar for that company, like Safaricom, who have paid you money directly without you selling shares. You use that money to buy another stock that is giving you dividend maybe the next month. You're not selling anything. Don't sell anything. It's the dividend that you receive. Deposit it back to your trading account. And here, remember, you have bought a counter that has declared another dividend. So that counter is a dividend stock. When you are paid by that counter, you are buying another counter which have declared a dividend. Ideally, what are you doing? You are using your dividend to invest in dividend paying stocks. They are called dividend stocks. However, you can also use that dividend to buy growth stocks. Growth stocks are the counters that gain in price. So you use your dividend, you buy a counter that you anticipate will rise in price. But remember, you can only realize that profit if you sell through capital gains. If you don't sell and it goes down, then you realize something called capital loss. That's why I said use a dividend to buy another dividend. Ideally, that's what I mean. Receive a dividend to buy another dividend, because you're buying another counter that will give you another dividend. Use that now new dividend to buy another dividend. You're recycling your dividends. Recording will be shared. Kara, let me give you my number. You can WhatsApp me or Telegram. Then we can pick up account opening. That's my WhatsApp number and Telegram. 0723 384 775. For those maybe who have joined through the phone, 0723 384 775. Kara, you can reach out. I will help you open the account. And if you need even one-on-one training, we are always available in the office, also on call. Even on weekends, you can always shoot me a message. If I'm available, I'll give you a few minutes. We go through whatever you want to understand. It's very important. There is one thing training you here and making sure you understand. If you have not understood, because it was a lengthy presentation, always reach out on WhatsApp. Let me share. It's not WhatsApp group, it's WhatsApp. This is different from WhatsApp group. Remember WhatsApp group? You are joining a WhatsApp group. This you are following, so that whenever I do any video, you can be able to see. Are there companies that perform well in stock market but don't pay dividend? Yes, there are so many. There are so many. They are called growth stocks. There are also other terminologies that you may find out there. Penny stocks are stocks that trade below, let's say, 5 bob, but the price movement is high. So those ones, the ones that don't pay dividends, are called growth stocks. If you do want to know more about it, let's meet next Wednesday. I will come now and train you dividend stocks, we go through them, and growth stocks. Vera, I've not completed editing last week's videos. I hope to complete today. After these, then share. I'll share them. Oh, East Africa cables, I'm coming to that. So I come to East Africa cable, and I think the issue here was on a Court of Appeal declining to grant orders, stopping Equity Bank from selling its 4 properties. I think you'll need to wait for CMA direction, because CMA are the ones who, as we said, they're the ones who regulate the market. Anything happening outside there, CMA gives direction. I'm not sure whether on their website, whether they have, let me just check whether they posted anything in relation to that, because CMA are the ones who are mandated to oversee some of these issues. Let Let me see whether there is anything from. They actually did just freezing the shares, such that you can't trade. And I think this was done together with Transcentury shares. Freezing means they stop trading for some time until that issue is completed. So until that issue with equity is completed, you can't buy or sell East Africa cables and also Transcentury. Just check business data, and I think in our stock recommendations and stock reviews, they would have put that commentary. Freezing means just stopping for some time until equity and East Africa cables and the court comes to a conclusion. Then based on that conclusion, CMA will give directions. And you as an investor, I don't think you can lose money. As I said, CMA, they have that responsibility to make sure you are compensated. Even if Equity Bank and East Africa cables, they fight forever. You as an investor, you'll be compensated one day. But for now, I don't think they are trading. They are just suspended for trading until court gives directions. And that's why I said, if you diversify your stocks, you avoid some of these things. And I would have hoped maybe we had done this presentation before these issues came in, because it would have opened you to know that maybe East Africa cables, there are issues and it might be suspended one time. So by that time, you prepare yourself. Let me go to Q&A. I can see there are some questions. That's a solid training and good presentation. Thank you. We appreciate that. What's your take on the impact of shareholders with trading suspension for both? I think these I've explained. It will depend on the court ruling, but don't be worried. CMA, they will give direction. You don't be worried. Be on the lookout on what CMA will say. CMA must, and they are required to give a verdict. Why would one not receive dividend despite holding shares before? You must have shares on book closure, not before. Remember, if you sell before book closure, what you are doing, you are removing yourself from the register. There is that register that is sent to the registrar to pay you. When you sell, you are removing yourself from that register. That register is sent 5 p.m. book closure date. However, if you have shares and you have not received your dividend, hopefully maybe that's what the question meant, always contact the registrar and copy the broker. In this case, always copy AIB Axys. So if that's what he meant, I think Revis have clarified. You only need to update your details. First, contact us, that is the broker. We confirm where you're supposed to be paid. If it has changed, we'll just update your details. Could you please share your advice on whether investing in companies that have undergone stock split or in high-priced stocks can be considered a calculated or strategic investment risk? I think it's all about your strategy. Are you looking at short-term or long-term? If it's long-term, be sure these are good stocks. If it is a short-term, remember prices are not that volatile and there are charges. For long-term, yes, you can look at them. Stock split, yes, the price goes down, but remember, as the company continues performing well, the prices will go up. Look at equity. Sometime back, they did a split and price actually improved again by twice. I do repeat intraday and vice versa. Intraday is where you buy shares today and sell today. The delivery is where you buy today, but you can only sell on T+4 because they set on T+3. So you sell on T+4. That is a major difference. Buying part. Selling side, you are getting your credit in your account and you can buy the same stock or a different stock. The difference comes in terms of compensation. Intraday, if you do buy and sell, we check the side that have our commission. Second reg, we don't charge you commission and levies. For delivery, nothing. Even if you buy and sell the same stock today. And if you do a transaction in intraday, a buy, you can't do a sell on delivery, because delivery now you'll be selling what you already have, not what you have bought. But if you are doing intraday buy and intraday sell, even if you have other shares, you are selling what you bought that day. That's what intraday is all about. Delivery, you can only sell what is settled. Other settlement procedures remain. It's only buy and sell, buy and selling the same counter, same day. Why is my ledger balance different from trading space? If you check the funds, you realize there are some items that are blocking your funds. Either there is a pending payment, you have requested to be paid, and that money have not been released, or there is an order that you have placed, but it has not executed. Remember, when you buy, we need to pay somebody. When you put an order, we don't debit you. We only debit when it is executed. What we only do is block that amount. In your statement, we have not debited anything. So trading space will be lower, because either if it's a pending payment, we'll pay you. If it's a pending order, we'll have to pay out. That's why it is blocked. I think Q&A, I'm done. Let's see on chat if there is any other question. One more. How can I transfer from a stockbroker to another? Just go to that stockbroker. You fill in a manual form. It's called transfer form. You just ask for transfer form from a broker to another broker. You fill in. Then you come to, now let's say you come to AIB. You bring that form. You complete. And before you do that, make sure the broker you are going to, you have already filled in. You have already opened account. If it is AIB Axys, you just open account remotely. You don't need to come to us. Once you receive your CDSE number, go to the other broker. You tell them, I want to move. Give me transfer form. That's it. Once they fill in, and it is a manual form, that's why you need to go to that broker. They sign, you bring, and we complete the transaction. However, you can talk to your broker. You see if they can set that form online. If they do it, just fill it, and we proceed. Will there be any charges for transfer? It depends on that broker. You just confirm with them. But I believe it could be only CDS charge. Just confirm with the broker whether there is any charge. I don't want to talk on behalf of them. Maybe they have a charge which I may not be aware about. So next week, Wednesday, we'll go now to differentiate growth stocks and dividend stocks. I give you that list and explain. Then we'll try and see. I think there are so many other topics I've not covered. Remember, I started with account opening, with what is NSE and what they do, and what they offer, and what AIB offer, what's the DSE and CME. Then we came to DigiTrader. I shown you how to trade, FAD, trade, open account, referral module. Then today we have come into details now, understanding the market deeply. Those terminologies now that you have had out there, now breaking them into layman. Next week is now breaking them even further, so that now you are, from your comfort, you can do everything. Now this Friday we are going back to international stocks again. We did up to ETFs and stocks, how you can buy. So this Friday we are doing now advanced topics, again explaining in layman. I usually prefer giving analogies with what you already know. So this Friday, be on the lookout tomorrow for that poster. If you are intend to invest in international stocks, even if you don't intend, it's always good to run this, so that when you make that decision, maybe Peter will not be in AIB Axys to give you this information. So thank you so much, and I appreciate your time today, and let's meet next week.